Fired.
Welcome
Now I'm a
back to the
content
ROI
creator.
channel.
I'm a minstrel singing for my supper.
He's a recovering academic. He's a value
Yes.
professor. He's Hugh Hefner's long lost grandson. He's got the stylish earphones in today. And guys, we've got a treat. Steve from the Unemployed Value Degen is back joining me today because I'm a little nervous. I can't explain it, but I've got a bad feeling in my bones, and he's going to talk me through it. He's going to talk me how to get through it or talk me down from my hysteria. Today, we're going to talk a little bit of macro, what Steve likes, what he doesn't like, and what his predictions for 2025 will be. And if you're a member of the ROI Club, you will have access to the second half of the video where the professor grades my homework, where I sell some long dated put options because I'm just a premium junkie and well, I'm lazy now. I don't really want to work. So if I can sell and run a one-man insurance company, I can live the dream of hiding behind my computer and making money. And I'll never have to interact with anyone ever again. Welcome back to the channel, sir. Happy Boxing Day where you are, because
Oh,
you're always behind. How are things?
that fantastic. What the heck is Boxing Day? Does that have anything to do with Vegemite or fairy bread in Australia? What are you guys doing down there?
Don't you guys have Boxing Day?
I think they might have it in Canada.
Oh, okay. All right. Sorry. Forgot you guys were Republic.
But is it about drinking Bundy rum and getting in fights? Is that
That's
Boxing Day?
more like Tuesday, Wednesday, Thursday, Friday. Boxing Day, I believe, was the day after Christmas. So in the lords in the house had their Christmas and the servants served up the Christmas food. And then Boxing Day was their one day of the year off, I believe, where they'd
Oh,
go
okay.
through like I guess the unwanted presents and unbox things. I believe that could be completely wrong. So, don't fact check me too hard on that. Culture's not our strong suit down here in the former penal colony.
It's the internet, so they'll correct you in the comments.
No doubt. What's happening, sir? Am I worried? Should I be worried, or should I not be
Well,
worried?
there are a lot of worries out there, and then on the other hand, they say, well, the stock market climbs a wall of worry. Um, we just had a 14-day sell-off in the value factor,
Brutal.
which it has only happened one other time. To have 14 days down and not be broken by a single relief rally, it's only ever happened one other time in 1978. So it's really a historical moment. But it had a nice little bounce in the last few days. This last week has been a little bit of relief. Um, I think what's driving that is the 10-year treasury. Want me to share screen?
The floor is yours, sir. The floor is yours. We've seen
Okay.
the 10-year spike. We've seen TLT spike. A few funds outflowed. So you're saying this could be tax loss selling in the bond market.
Yeah. So I think a lot of people in the market were, let's see, they were following this trend line, which is it? So this trend line had been trending down, and it made us think that we could potentially have a 3-year uh, we could potentially get to a 3% 10-year treasury. A 3% 10-year treasury would give us a 5.5% 30-year mortgage. A 5.5% 30-year mortgage would unfreeze the housing market, and then we would have the whole market would unthaw. We'd have massive amounts of activity, and the 10-year treasury had been well behaved in this channel until it wasn't.
Until it wasn't.
And you
So the
have
question is this an anomaly or are we going back into the plan in terms of the range, which will, I think, generate more inflation if it comes back down below that trend line that you mentioned?
Well, if we hit a 5.5% 30-year mortgage, then I think inflation would come back because you'd have, I don't want to get too in the weeds for, being an academic, but with the fractional reserve banking system, every time a bank makes a loan, it increases the money supply. And right now in the US, after the global financial crisis in 2008, house prices fell, but everything was fully mortgaged. There was no collateral to put loans on. And so the system needed some more money, and the banks couldn't find any good collateral, though it didn't matter how low the interest rate was, there was no collateral to make loans of. Now we have $32 trillion of housing collateral because house prices went up with this 40% inflation spike. So with $32 trillion of housing collateral, a 5.5% 30-year mortgage, people would be more free to, move to the senior citizens might want to downsize to a smaller house. They might want to sell their McMansion. Then, younger people might want to take out a home equity line of credit or a home equity loan and buy a jet ski or a Harley Davidson or something like that. So yeah, I think at a 5.5% 30-year mortgage, inflation would go absolutely wild. Now, this recent spike outside of this channel, I think that's entirely responsible for the sell-off in value. And the question is, what the heck is the 10-year treasury going to do? And my best guess, and I wasn't thinking about this because it's so rare for it to happen because interest rates have fallen for 40 years. I think people tax loss harvested treasuries, which people were not expecting. Nobody was expecting that to happen because how often do prices of treasuries fall enough for them to be a tax loss harvesting target? But I think that's what happened is that, people had all these gains on the Magnificent Seven.
Yeah.
They wanted to offset the taxes and people sold treasuries. And if that's
Great.
what caused this spike,
Okay.
then as soon as you get
Now,
30 days out from the selling in
let me
January, they can
interrupt you a
buy
little
back
bit.
in.
So we think maybe tax loss selling caused this spike, but this is what, a 50 basis point move in the 10-year. And how much have value stocks sold off in the last month? It's a lot more than 50
Um,
basis points.
yeah, so there was a pretty big sell-off in value. Is this, let me just go to, so one of the ETFs that is I use just to show the value factor is the S&P 500 value ETF.
Right.
Now, did my share screen follow with that? Because there's two different kinds of share screen in Zoom. So are you
I'm
seeing my new
following you.
chart?
We're following you live, sir. You are at the virtual whiteboard.
Yeah. So if I go just out to 3 months, and then I have to change all the settings so it makes sense. Candlesticks. Um,
Oh, no.
so yeah, you had value selling off from just the start of December. And a lot of people are blaming the Federal Reserve meeting, but the Federal Reserve meeting was back in November. This huge, massive sell-off just started exactly December 1st, and it crashed hard. What percent change is that from, call it 205 to, 189? It's a pretty big crash. Um,
The
but
10%.
a lot of that again is this is going to be tax loss selling targets as well as all the value stocks are down this year. So you got tax loss selling in value and then tax loss selling in treasuries raising interest rates, causing even more selling in value. Um, I don't read too much into this, and then I can go back out to maybe go out to the 1-year trend. And I did a write up on my Substack about this. It's still a bull market, and in a bull market, these dips are pretty decent to buy. And so let me just go to the
So I can see there on your 1-year line, we still haven't broken through the 200-day moving average. That is
yeah,
presumably the red line there. Okay.
yep, exactly. So we didn't even retest the 200-day, much less bounce off of it.
Right.
So there's a lot of reasons why it felt scary while it was happening because 14 days with no relief. In a lot of other drawdowns that could have been spread out over more time, or there could have been a little bull trap in there, just a little bit of a relief rally. But 14 days of no relief is just psychologically terrifying.
I see. I see. Okay.
It's all going to come down to what happens in January. And I think, in January, you're probably going to see one of three things. People who sold bonds for tax loss harvesting are going to buy back into them. People who sold bonds for tax loss harvesting are going to buy into something that should be negatively correlated to stocks like gold or energy, or
That's
people
what I
who
was
sold
talking.
bonds are going to buy stocks because they're the only thing that's working. I think one of those three things is going to happen. Now, because I long a falling 10-year treasury is good for stocks, so that's fine. I'm way overweight gold and energy, so that's fine. And I'm way overweight stock, so that's fine. So any one of those three things is totally fine by me if people that sold bonds take that money and put it into pretty much anything other than the Mag 7. But if the Mag 7 runs for all of 2025, it's going to be a painful year again. And this is the Mag 7. Well, it's the big tech ETF. And It had that tiny little dip. Um, it suffered really just that exact day that the right. This is just the day that Jerome Powell spoke and
And
told
what
the
he
market it
said,
was.
if I remember correctly, was just there were no rate cuts on the horizon. I mean, he didn't raise rates. The market was
Well,
expecting, I think, 4 cuts, and he said, no, that's not going to happen, something like along those lines.
yeah. So the market was pricing in a full percentage point of cuts for 2025, and now they're only pricing in two. So it went from four cuts to two cuts. And Europe is already 1.25 percentage points lower than us, and Canada is already a percentage point lower than us. So the globe is in a cutting cycle, and the Chinese 10-year treasury is 2%. So for the Chinese 10-year treasury to be 2% and for the US to be 4.5%, I think the cutting cycle still has some room to go. I don't think we're back on a interest rate rising cycle yet. Right? I think there's going to be the interest rates are going to rise again. Things go up and down, but I think there's going to be another year or so in there of this interest rate falling cycle.
Okay, so you would see the DXY softening, or because as you've mentioned, everywhere else around the world is cutting as well. It might be a case of, okay, the US interest rates are dropping, but that's not going to change the purchasing power of the dollar necessarily in comparison to other fiat currencies because
Yeah, so
they're all in the same boat essentially.
I've been following the DXY, and it really just broke out of this channel that it's been in for a couple of years, um, and it broke out to the upside, and that was so I put out that trade alert that said when it got to this line, it's time to buy something international. So I bought some PagSeguro in Brazil. I bought some El Crasud in Argentina.
Hmm.
Um, and I think the mentality is everybody believes Trump wants a weak dollar. And I think that's true because he wants to promote exports. I think one of the problems with that is so many other countries are in such a worse position than the United States, especially countries like Canada that have floating rate mortgages
Yeah,
and
Australia.
and right in order. So the game theory for countries like Canada and Australia and the UK and Europe with floating rate mortgages are right. They either inflate so that they don't have collapsing housing prices because the mortgage burden is so high,
Yeah.
or they have this huge populist revolt against people who are crushed by their primary residence costs. So I think the push in and also China is stimulating to get out of their overbuilt apartment crisis. I think so many other countries need to stimulate so much harder than the U.S. The U.S. dollar might stay strong. And I still think we could have a nice, couple months of reversal, but I think this trend might really break down and the dollar might stay strong because
Yeah,
we
I
have
agree. Yeah.
cheaper electricity than most other places. I think China is beating us now on cheap electricity, but everywhere else we still come out number one on cheap electricity. We're the energy exporter. Our interest rates are going to be somewhat higher because we can't cut to. I mean, Canada's already or Europe is already at a 3% benchmark rate. Canada's at 3.25. We can't. It'll take us a year and a half to get there, and by then inflation will be back. So I think this
Indeed.
trend might be broken, but I think I think interest rates can fall from here if it really is the tax loss selling. But it might mean that we don't actually get to a 3% 10-year. Maybe we end up at something like maybe this is the real channel that we're in. Maybe we only see
Three
a
and a
three and a
quarter.
half percent 10-year, something
Yeah.
like that.
Yeah. Well,
But
this is
I think we're
interesting.
still in a falling interest rate cycle, at least for another year.
Yeah, and I don't think that's going to change the Forex market too much. I'm looking at the Aussie dollar US dollar cross rate, and it has been murdered since October. Like the Pacific peso has lost 8%.
Well,
Uh,
and the Canadian peso, right? The Canadian peso it's like 69 cents to the dollar. It's absolutely brutal.
and this is what's got me a little bit worried, Stephen. So I am still based here. I've got most of my savings, my fiat savings in USD because I generate USD and AUD. I've got gold, I've got crypto, I've got stocks, and I'm looking to make some pretty big purchases in real estate in South America in 2025. But at the same time, I would like to keep some liquidity and keep making money off the brokerage balance that I have. So, ergo, the long dated put options sales, which we're going to talk about in the second half of this video. Good idea or bad idea to be looking outside the US? What if I have a little bit of a blended approach? If I've got some US stocks, most of my stocks are US focused, as we know. We've talked about the land holdings, particularly in the Permian. Real estate, as I call it, so tangible, developed real estate in South America is a specific play for me. Where else should I be directing my funds? Where do you think capital is going to flow to in 2025? What happens if people like your former brethren, the financial advisors, say to all these boomers with this 32 trillion in collateral, hey, maybe you should put 1 or 2% in gold. What would that do to the gold market?
Well, this is one of those things. If you look at the price of oil and gold, those things are always quoted in US dollars. And the price of oil at 70 US dollars, people, oil is under pressure at 70 US dollars. But if you price it in Canadian pesos, oil's at $100 in
Hmm.
Canadian.
Hmm.
And these Canadian natural resource companies, they're paying their people salaries in these Canadian pesos. So they're going to be extracting resources, selling them on a global market. They're getting $100 for their crude oil already, and their
And
wages
arbitraging their
haven't gone
expenses.
up 40% with the decline in the Canadian dollar. So I think the best foreign stocks are going to be the ones that are making these global commodities that are going to get US dollars, and they're paying their labor costs in these depreciating currencies. So I would look at uh, Canadian gold and oil stocks. I would look at and also any stock that's growing faster than the currency depreciates. I mean, I'm in PagSeguro, and they grew revenue in Brazilian reals by 30% last year, but that's declining in terms of US dollars because the depreciation of the Brazilian real has been so much.
Correct.
But at some point, there's going to be some move back in the other direction, and all that pent up growth in reals is gonna show up and be revealed to show the market that the company has been growing. So if the company is growing fast enough in their market, or if they're making an international commodity that they can sell in dollars. I mean, everybody's down on oil, but it's if you put that in other currencies, compared to how strong the US dollar has been, for
Hmm.
oil to still be at $70 should be terrifying people right now. Because on this record dollar strength, oil is still at 70 US dollars. But it's 100 Canadian already.
Yeah. Here's the thing. So I 100% follow your theme. I have invested and made some money following that in the past, more so in the Petrobras, Ecopetrols of the world. Canada has not been a happy hunting ground for me traditionally. Done okay. The only Canadian exposure I have is, surprise, surprise, Prairie Sky royalties. I just, unless there's a regime change in Canada and Justin Castro is extradited, I think October they go to elections.
Well, have you seen the polls?
I can't get excited about the place. I'm sorry. It reminds me of Australia, but with worse weather.
I just yesterday looked at the polls for Australia and saw how you guys are kind of neck and neck with no clear outcome. If these polls in Canada are even close to accurate, it looks like the Conservatives are going to come in with an extreme supermajority. I mean,
Yes.
they had Justin Trudeau's party going from 180 seats down to 30 seats and losing 150 seats. That is a shocking poll. I mean, that's got to go down as one of the worst political leaders in all of history to go from,
No doubt.
if that outcome obtains, if that poll is correct and he loses, his party goes from 180 seats down to 30 because of his leadership. Um, and I mean, people are mad at him. This is a guy who had the mounted police trample old women when they were protesting, right? People remember that stuff. So, but then you have Australia, and it's neck and neck. And are the left-wing environmentalists going to stay in charge and keep burdening all these mining
Well,
companies with
there's no
tribal
real
rights?
opposition here. That's the issue at the moment. You've got the Labour Party and the Liberal Party, and they're just different shades of the same nastiness. I'm trying not to use very colonial language on air, but it's quite depressing. And if you look at we were promised 400,000 immigrants capped this year. I think we're up to the last stats I read was 663,000. And then you had 90,000 of those, so roughly 13% were in inverted commas skilled immigrants. But here's the kicker, you had a diaspora of 85,000 Aussies, which actually left the country. So you've got like 5,000 net skilled immigration. I mean, the whole thing is touching on what you mentioned, trying to prop up the residential property bubble, which, aside from some of the nefarious actors involved in the residential property bubble here, is essentially the economy, selling visas, selling houses, laundering money through the housing market, and holes in the ground. So pretty
Yeah, I
banana.
was going to ask those immigrants, do they come with houses? Do they bring houses with them when they come?
Well, you see, what you need to do is you need to bring in, we need immigrants supposedly to build the houses to house the immigrants.
Yeah.
And the fact that we sell and clip the ticket on visas and all this sort of thing is purely incidental. And for anyone who's going to somehow throw this anti-immigration narrative towards me, I myself am an immigrant, and my partner is an immigrant, and she's been here for 6 years, and her cohort are the ones who suffer the most. They worked extremely hard, and now they're having their Australian dream literally taken away from them because it actually doesn't matter how hard they work and paying thousands upon thousands upon thousands for essentially having their degrees recognized and all this sort of stuff. It doesn't matter how hard they work, they're not going to get ahead. Pretty tough
That's what happened in the
sport.
US when Democrats were shocked that legal Hispanics voted against illegal immigration because they just got here, they did everything
It's
the
not
right
fair.
way,
Yeah.
and now they have no advantage over 10 million people that, you know, pay to be smuggled across the border and support organized crime and all that stuff. It's so anyway, that was I mean, I think people could have predicted that, but the people who were surprised by it were the election losers.
Yeah. Anyway, I'm not sure we took a bit of a detour there, but I enjoy it. So, number one sector for conviction. You mentioned those three outcomes. I'm going to throw it out there. I don't think you're going to be buying Mag 7 next year. But hey, maybe that'll improve all our returns. Who knows? Gold and value stocks, energy. You've got decent exposure to gold and energy. What about the value stocks?
Well, I mean I'm full up on value stocks. So I've got a few different I've got a few different themes that I try to invest on. And I'm, you know, the dominant theme for the next decade is going to be the AI center build out. And it's not that I'm against investing in it. It's just I run into my competence limits when I try to analyze the company. But I did have one stock that I found. So I have one holding that's a data center build out beneficiary. It's called Applied Optoelectronics. They make these little tiny they make these little tiny connectors that when a fiber optic cable needs to connect with another fiber optic cable is a special piece of hardware to do that. And they have contracts with 3 out of the 5 major hyperscalers. So it's not that I'm against the data center build out. It's just that I'm not skilled in analyzing tech company. So I
What
still
about
think you should
land
have.
companies where they're going to house the data centers?
Well, there you go. So you can win both ways. You can own land and you can have that exposure as well. They can pay you to right. They can pay you to dispose of the water from the fracking, and then you can build the data center on the same land where they dispose of the water, and you can have a pipeline going past it to dispose of more water, and that's your Texas specific land bridge. But
Sweet,
so
sweet music to my ears. So talk me through this. Well, it sounds like you've identified a bottleneck then in terms of these hyperscalers that are they need that specific type of hardware. Tell me a little bit more about that, if you would care to do so.
Oh, and this is another area. I'm not an expert on all the different components in the data centers. I mean, there's people who invest in the companies that build the racks that hold the chips. And there's people that invest in companies that do the liquid cooling that cool the chips. I mean, if you want to, so this is an area where, again, it's very exciting, but prices have already run up somewhat. And then I hit my limits in my competency. And I was just by pure dumb luck, I was able to find one thing before it ran up. And I think you could go sifting, you know, in the tailings of this data center build out idea and probably find some stocks that haven't moved yet. I just think it's very hard, and just my own personal skill set, I'm not very good at it.
Okay. So tell us about this particular company then. What's the ticker and what sort of
AAOI, applied.
AAOI
Yep.
and Applied Optoelectronics? And what do you see happening? What kind of growth run rate has it got ahead of it? Holy moly, the thing is up. 52-week low, $6, 52-week high, $44.
Yeah. So again, and this is, I just found one thing before it ran, and then the next question is, okay, how high are these things going to go? And I've even already sold a call on this one at $35. So and I probably was early, because it'll probably go to 60 or 70. But it becomes really hard. Do you keep buying more of this stuff? Do you take money from other places? Do you take your marginal profits and buy more of this stuff after it's run up so much?
Mm.
But it seems like this AI build out is going to be a 10-year story. But then that's why I'm a value investor. I find this kind of investing hard to do, to be able to pick, is this overdone? Is it not overdone? It's painful.
Yes. And a value is easy to identify, but on the entry side of things. But if we are on the verge of seeing the worst inflation that we've seen in maybe 200 years, what I like to do on my time off is read through transcripts from Murray Styles' earnings calls because I'm a weird guy. But that's a comment that he made yesterday in a call I was reading. Maybe we need to rethink our relationship with the numeric prices on things like the price of a barrel of oil. Oh, that seems high. These growth rates seem high, or they seem low. Or this seems overvalued at 1.5 times book or 2 times book. The old strategy of buying something at 30% of book value and then just selling it when it gets close to fair value. Are you re-examining that, or you just have faith there's always going to be another
Hmm.
something else to buy in the bottom of the dumpster?
Yeah, I mean, so one of the areas where I've been looking is small cap tech. I call this theme the revenge of Cathie Wood, because even as the market has been booming, anything that people believe has competition to AI has been really beaten down.
Hmm.
And so even when a company has enormous market share, enormous contracts that are hard to compete against, and they're actually implementing AI themselves, the share price still hasn't moved.
And is
So
that because people are worried about the duration of their earnings? They think that they're going to be surpassed by technological changes.
yeah, I think that the AI tech maximalists believe that every company that is software based will just be a zero, without doing all the work of digging through to see, is this company the one that's actually implementing the AI platform that is going to be the new market winner anyway. So one example for this is a company called Nerdy, and people in the U.S. might know them as Varsity Tutors. So if you are struggling in your college class, you need a tutor. You go through Varsity Tutors, and they teach you they help you pass your exams.
Okay.
Now, the stock that probably is more dangerous is Chegg. So when the large language models came out and people found out that one of the first use cases was you could cheat on your homework assignments. Well, the software platform where they were cheating on their homework assignments, Chegg, that crashed immediately. But all the other education stocks crashed with it. But thing is, Varsity Tutors, there's a difference between using a online service to cheat and using an online service to learn to actually pass the test legitimately. And so I think Nerdy has been thrown out with Chegg, and it's totally undeserved. Because for one thing, they're implementing the large language models themselves, right? They are going to be the AI tutors as well, right? They'll have the real tutors and the AI tutors.
Sure.
And then on top of that, they've been once in software, once you hit zero marginal cost, you can start giving away your product pretty cheaply. So they've been going out to all the public school districts and offering a free platform that, if they get some funding from the Department of Education to like tutor their 30 slowest students in their high school, that's going to go right into their Varsity Tutors platform. And then everybody in that school district can have an account with them. And if some parent finds out their kid is a little slow, are they going to look around the neighborhood and try and find their own tutor, or use the place where they already have an account and a login and just, start paying varsity tutors. So they've been getting,
That seems a pretty tough theme to play, mate, to be honest. I'm looking through, they've been burning through negative net income, negative free cash, supposedly inflecting the positive free cash in 2026. Is that a theme worth, is that an easy way to win? Or have we just got easier ways to win in some of this more revenge of the old economy, the
yeah.
energy industrial type stuff?
Well, that's so the revenge of the old economy. I am extremely overweight, and I've been extremely overweight for 2 extremely painful years. And it could be that 2025 is the year when the old economy and the commodities start booming again. I think there's pretty good odds of that because we had all this GDP growth in the US under Biden, but it was all government employees and healthcare administrators, right? There was nobody that actually did something physical and used any real commodities in their job. In fact, they were even working from home and telecommuting. Something like 94% of government workers are working from home. So if you have Trump, which is going to, he's said he's going to rubber stamp all permits for every investment over $1 billion, and then we're going to have a extremely accelerated depreciation from the tax code. So the chance to unclog some of this commodity driven economic growth is huge. China has declared that they're going to stimulate. India is growing at 7%. It's really only Europe that is still kind of on the struggle bus. So the chance that 2025 is the year that the revenge of the old economy works is pretty good. But I am so overweight commodities and materials and all this old economy stuff that I don't need to add any more there. And in the meantime, I'd like something that would work if we still end up having 2025 in this world where it's just all tech and software and data centers and AI.
Okay, fair enough. Adding on that potential free trade agreement with Argentina, potentially on the table, that might be interesting. Cheap new shale rock down in Vaca Muerta that's being growing like wildfire. So it could be interesting to keep an eye on. Okie doke. You've got a model portfolio that's available for paying subscribers on your Substack, which I use quite a lot as inspiration. Um, Anything you'd like to say on that before we move into the next segment?
Well, so one area that just on its own cycle. So I try to find things that are on their own cycle. It's not going to be tied to every other cycle, which is hard because a lot of times things will just all move together. But agriculture is doing its own thing, but the agricultural cycle is whenever you have a crop failure in a staple crop. So we had crop failures in cocoa and in chocolate, but that isn't related to any of the staple commodities. You've seen the price of cocoa and the price of cacao go crazy, but the agricultural, the staple food crops, we've just had 2 years where there hasn't been a single crop failure anywhere. So all of those are down. And so all of the agricultural commodity stocks are cheap. And all it takes is a weather event that hurts, rice or corn or something like that. And they all spike. And that would be, now that could be next year, it could be in 3 years, who knows? But it's independent. So if nothing else is working, that could work. And the other is logistics. So we've had since the overbuilding during COVID, when we had that supply chain crisis and too many people got into logistics, the system has been cleansing out the soft hands, the weak players. And we're probably getting, if we're not already at the bottom of the cycle having inflected, we're really close. So I have, I was in Forward Air. I'm looking to exit it, hopefully at a better price. But I've been building a position in Heartland Express. And I think logistics is worth looking at because there's just a good chance that whether, if we're in this, software-based economy, at least the consumer is going to be buying stuff. And if we're in a more commodity-based economy, then stuff is going to be moving around. And just the independent cycle on its own, there's been enough bankruptcies in that transportation sector that we should be getting back into, stronger trucking rates again. And one of the ways to measure this is the tender rejection rate. So people say, hey, I want somebody to deliver this cargo for this much. And you see the percentage of times that offer is rejected. And that number is now at a 3-year high. So it seems like we're finally coming out of this destocking cycle. We're finally going to be moving cargo around again. So I like logistics as a potential. If the commodity super cycle doesn't work in 2025, logistics still has a good chance of doing it.
Okay. So you're always looking for non-correlated sources of alpha on the long side, not tempted to take a short position or out of the money put option anyway?
I shorted in 2022 because interest rates were rising, but shorting is so hard. And it's also hard. It's not only hard to do the analysis, but it's hard psychologically. And if we are going to be inflating, then you're shorting something nominal and prices are going to be rising behind you. So not only is shorting hard, it's and if we're in a falling interest rate environment, it's just not a great time to short. It does great things for the portfolio if you because that you can really have a negatively correlated asset in your portfolio. But and I did short in 2022, but I don't feel like shorting this year.
I've got an idea that I'll send you privately that's based on negatively correlated with the roll yield of something in a contango and some of these ETF trackers at double or three times leverage. They're basically path dependent and they're almost guaranteed to end up at zero. So I think they might be interesting for you to take a look at. Guys, next segment is going to be for the private subscribers. Okay, so if you want to become a premium member of the ROI Club, the link will be in the description. And what we're going to talk about, we're going to share the screen on the Maverick Life portfolio. I've got a ton of cash burning a hole in my pocket. So I've got nearly, well, 20% of my portfolio in cash as collateral. I like receiving US dollar interest on that cash. I want to make more money on that cash and I want to spread it out over a long period of time where I can really only, if I'm using options wisely, I can generate that as another source of income. And worst comes to worst, I may have to buy more of the stocks that I already like at big, massive, fat discounts. So that's going to be the idea that we share. And the prof is going to give me his take on things. If you want access to that, by all means, sign up today. You can get a free trial. And I look forward to catching up with you on the other side as a member of the ROI Club.